Not everyone is on board with investing in China's reopening recovery. And so what's interesting is some people are actually indirectly getting exposure to the potential for this recovery. And so that's what I want to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. So there are people who are just like, look, we got burned once by investing in China and we're not going to do it again. And so they do want exposure to international equities. And so one of the ways that they're doing it is they're finding indirect ways to gain exposure to the reopening play in China. And this is what I'm talking about. So this was an interesting article that was released in the Wall Street Journal, and it's essentially saying that many investors are skeptical of jumping in on China's recovery. And part of that is just people are weary because they got burned already by the CCP. And so why invest in a country where the CCP could just make a particular decision and then all of a sudden all your capital is gone? And so some people are looking for different ways to bet on the reopening. And what exactly do they mean? Well, first, the article goes in to say that the early data is pointing towards a fast rebound in traveling, eating out, and revenge spending. And I thought this was a very interesting term, very funny term, I would say. And so I hope that there's some revenge spending on that Alibaba share price, because I'd like to see that at around like $200 a share. In fact, I actually would rather see it lower for longer, because I'd like to buy more. But of course, everybody who's invested in Alibaba, they want to see that share price go up. And I would be happy if it went up as well. And so Goldman has actually called for the MSCI index to reach 85 by the end of the year. And so that's an increase of more than 33% from where it is today. And so, another institution is super bullish on Chinese equities as well. UBS has labeled Chinese equities the most preferred of its global strategies. And they wrote a report last week that says that the equity markets exposed to China's reopening look like a better opportunity than US markets. And so effectively, with UBS and Goldman, you can see that the institutions are coming back around. And, you guys already know that, individual investors don't necessarily move share prices. I mean, we saw individual investors move some share prices over the last couple of years, particularly the meme stocks, but really it's the institutions that really move these share prices. And so if the institutions like Goldman and UBS are coming around to Chinese equities, you could see more fund flows come back into the country and push up those share prices, which would be, absolutely welcomed by people who sort of like weathered this storm. But guys, I wouldn't get too excited about the institutions moving quickly into the China reopening trade, because I did call this out in a previous video that the US and China are not actively mending fences at the moment. There have been rising tensions and hostility between the two nations. And so, we'll see how this plays out. But, for every, piece of good news, we always seem to get another piece of bad news, which kind of just like keeps people shy away from Chinese equities, as it seems. And so here's what the article went into when it said, there are some interesting ways to play the reopening play. And so, people are investing in Starbucks, Nike, Marriott, LVMH, Moet, Hennessy, Louis Vuitton, all companies that have exposure to the Chinese economy. The other ones that I would add are Tesla, Apple, and even Canada Goose. That's one that I have exposure to. Canada Goose, one of their main focuses on growing in Southeast Asia. So not just China, but, part of it is in China. And so, there's, of course, ways to invest in the Chinese economy through North American companies, and those are particularly the ones that have exposure to growing their businesses by expanding into China. So that's a very interesting way of thinking about growth and focusing on your portfolio for the next 10 years. Well, one economy that's going to be growing at a rate faster, at least in my opinion, than the US would be still the Chinese economy. People are forecasting them to grow anywhere between 5 and 7%. That's going to be much higher than what the North American economies are growing, at least in my opinion. So, very interesting strategy, something that I didn't really think about, or at least didn't directly think about. So I really wanted to highlight it because I really enjoyed that somebody pointed it out in this article. And this really goes into, the investors' fear and nervousness with investing in China. Fears of government interference with the companies or the country's technology firms have also eased. And so I guess that's fine. But I'm telling you guys, like, I listen to, at least retail investors talk about it all the time. People are still afraid trade. But I would agree that like I'm less worried about this, but I think it's just because I'm a little bit closer to it, but I also might be a little bit delusional. And so the valuations of those firms are cheaper. Like Alibaba's ADRs recently traded at less than 10 times expected earnings over the next 12 months. Meanwhile, the S&P has a forward multiple of 17.5 times. And so, one investor went on to say that I think history has demonstrated time and time again that stocks can feel uninvestable today, but turn out to be great investments going forward. And I absolutely agree with him. And, just looking at the tracker, this is something that I look at every day. You can see on top of our tracker is Alibaba, trading at around $80 per share. I believe that the intrinsic value of the company is around 200. I don't know very many investors who have an intrinsic value for Alibaba that's under $200. And so I think most of us feel as though the company's trading at around 40 or call it even 50% of its intrinsic value or trading under that. And so, I believe that the 1-year forward P is 16 times earnings, but, I'm more pessimistic on their results than I think the market is. And that's fine. It's still cheap as far as I'm concerned. And then Tencent, I think that they're trading at 20 times earnings, which is, very cheap for a company that's, very future focused and growing as fast as they are. And so, both of these companies are on the tracker, and you can click into this ticker link right here. It's blue and it's underlined for a reason. You can click right into it and get to the model for these particular companies. And guys, just a reminder, Tencent will be reporting this week or coming week. It looks like they're going to be reporting on the 22nd. And so just to be aware of that, that is something that I will cover on this channel. So the question is, how do you get access to this tracker ahead of time? Well, you can get access to the tracker and all of the models that I have at this lower tier of the Patreon. So I highly encourage you guys to join in. If you want to join us for an epic live presentation, you can join us on the higher tier every month. Now, speaking of investing in Chinese equities, I recently put out a video where I sort of like weighed my options with taking a look at Alibaba from the perspective of like a double or a triple down. And the way that I did that was I looked at the different sort of like options, cash secured put and covered call opportunities. And so if you missed that video, no problem, you can get to it right here.